Welcome back to Market on Close. We have just a few minutes left in the trading day, so that means it's time for our big picture panel. Let's welcome in our team from Charles Schwab today. Nathan Peterson is joining us. He's the Director of Derivatives Analysis at the Schwab Center for Financial Research. Nate, thanks for being with us today. Let's just start by what your thoughts are on today's action.
Yeah, hey, Marley. Pretty impressive to just continue to kind of march higher. There is some sign, if you look at the Russell today out of the majors, I mean, it's obviously outperforming. Tech is the underperformer, relatively speaking. And so I just think that as you grind higher here, look, when we have these catalysts to look forward to, and that being these, trade deals that potentially could come to fruition, some of the earnings reports that help validate the strength of the economy, and earnings has looked better than expected, relatively strong. The earnings forecasts going forward still look healthy. This is still providing enough juice or excuse to continue to march higher. And right now, I just kind of watch and see, well, hey, when we're getting good news, are we responding, in the same type of fashion we might have done so a couple months ago? Earlier in the trading today, it looked like we were, maybe going to even move down into the red. It looked very tentative, but then, around late morning, we really picked up that action. Looks like we're closing near the highs of the day. It still tells me that underlying strength, that underlying bid to the market is still there. But I think if you are in this market and you're just kind of looking at, the price action, seasonality, which might get a little bit more tentative here in the coming weeks, months, we could get hit with some rotation out of technology or some of these high flyers as money looks for a place to potentially catch up to the rest of the market that is at all-time highs, or the S&P at least. And we're seeing some of that today within, healthcare, industrials, et cetera, where the money is going there. And it started, I feel like, last week with Netflix when they posted a beat raise, and they weren't screaming at all-time highs going into the report. They had pulled back to their 50 SMA, and yet they still sold off that stock. We saw some of the sell in the news on the financials. So I think you've got to be a little bit cognizant that, okay, because we moved so quickly and in such a short period of time, the potential for a sell on the news as we get companies like Alphabet, Tesla, we'll take a look after the bell today, and then more of the mega cap techs Wednesday and Thursday. We get 4 of them. That's going to be a really key test to see if this sell on the news actually does exist. But after we get past August 1st, after we get some of these trade deals, let's see what happens with the EU. We could get to a point in early August timeframe or so that we've gotten most of the earnings out of the way. We priced in a lot of the good from the trade deals. The economy looks good, but now we don't really have another catalyst to push us higher in the near term. And then that's when we potentially could get some kind of a mean reversion digestion of some of these, spectacular gains we've had.
All right, so a lot to unpack there. First, let's start with trade deals. You mentioned trade deals. We did get one today with Japan. We're hearing rumors of a potential trade deal with the EU. Was the market reaction here what you expected it to be?
Well, I do think that because the Japan tariff rate was 15%, that was perceived as better than expected. If it would have been like 20, 25, we may have been in a different camp there, because I felt like if you go back to last week, it seemed like a lot of these tariff rates, based on all the commentary from the administration, was we might be preparing for a somewhere between 19 to 40% tariff rate on these countries as some of these deals have come in. And I've got to give President Trump credit. I mean, it looks like he's, put together some really good deals for the U.S., where Japan is investing $550 billion, 15%. I think that's a good rate for the U.S., and where the market feels like it's not too hot, that we don't have to worry about that rate too much, at least not yet. It is higher than 10. Let's see what happens with the EU. It seems like that's a little bit more difficult, but having established some of these deals with the likes of Vietnam and Japan, perhaps EU has a better sense of, where they can find some middle ground. And, if it comes in 20, 25 on the EU, or if the EU still remains reluctant, that could create some volatility in the market because we still don't know what 15 to 20%, let's just say that's what it's going to be for most of these major countries, 15 to 20%. We still don't know if that actually has any impact on inflation. So I'd say net it's a positive based on expectations, but let's see what happens with the EU.
Yeah, certainly, and we seem to be in this somewhat sustained rally, minus a few pullbacks. We seem to be just generally moving up. What do you think some of the bullish and bearish forces are at play, in addition to tariffs and tariff talk?
Yeah. So, okay, look, on the bullish side, it's been, hey, the economy looks great. The inflation hasn't shown up. The Fed isn't giving us rate cuts right now, but that hasn't really mattered. They're kind of on the back burner. You're seeing a lot of these CapEx binges, so to speak, within power, AI, et cetera, and the like. And that, you would think, is going to be that kind of investment. Industrials, new all-time high today. That kind of investment is going to be good for the economy ultimately. So that bullish narrative is that basically we have this resilient economy backed by these secular growth trends with a benign inflationary backdrop and momentum and technicals working in our favor. That's the bullish case. And that's why you've seen like this persistent march to new highs. And then on the flip side, if you're bearish, you would say, well, yes, but we're coming into bearish seasonality in August and September. We have full valuations. We don't know what the impact is going to be from these higher tariff rates. If Chairman Powell were to exit the Fed early, somehow, some way, either voluntarily or if some news around that were to surface and long-term yields reacted negatively, meaning the 30-year started to move back up towards cycle highs, you better watch out for that. That could be enough to really get or shake the bullish confidence that we have right now. And so I think it's just those two paradigms that we have there. You could say, yeah, we've moved too fast. We priced it in. Therefore, we're likely to get sell on the news or at least some mean reversion. We have bearish seasonality. And then on the other hand, you're saying, yes, but we continue to see evidence that the economy is really strong. Therefore, stay with the trend. The trend is your friend. And so it's just this, there's always a bull-bear battle, but here it feels a little bit more tense near all-time highs.
Nate, we really appreciate it. Thank you so much for being with us. That's Nathan Peterson from Schwab Center for Financial Research.